Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. The saying, cash is king, is often used, but when it comes to investing, cash flow is king. In this video, I'll share my insights as an investment analyst at a big investment firm to help you understand how to analyze a company's cash flow statement. Whether you're new to investing or have years of experience, I promise you'll learn something valuable by watching till the end. Let's dive into the video and discover practical tips you can use in your investment research right away. Cash flow statement. The cash flow statement, also known as the statement of cash flows, is a vital financial document that summarizes the cash inflows and outflows of a company. It provides insights into a company's financial performance, sources of cash, and cash utilization. Investors rely on this statement to assess a company's operations and its ability to generate cash. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. The operating activities section shows cash generated from the company's core business operations. The investing activities section covers cash flows related to investments such as acquisitions and purchases of assets. The financing activity section involves cash flows from investors in banks, as well as cash used for dividends and debt repayment. Analyzing the cash flow statement helps investors evaluate a company's cash generation and financial stability. Understanding the components and structure of the statement is crucial for assessing a company's financial health and predicting its future cash flows. Net income. The initial entry on the cash flow statement is a company's net income, which is often the key metric used to indicate the profit a company has made. Net income is typically mentioned when discussing a company's financial performance. To delve deeper into analyzing financial statements, you can refer to the income statement. Operating cash flow. Following the net income at the beginning of the cash flow statement, the objective of the operating activities section is to determine the net cash provided by operating activities, often known as operating cash flow. Within this section, there are several significant items that require attention and focus, which I'd like to highlight. Line items. One significant line item to note in the operating activity section is depreciation and amortization, which tends to be one of the larger amounts in this part of the cash flow statement. Depreciation refers to the gradual reduction in value of an asset over its expected useful life, and companies can deduct a portion of this value as an expense for tax purposes each year. To illustrate, let's consider Coca-Cola purchasing a piece of equipment worth $1,000, expected to be used for 5 years. In this case, the equipment depreciates by $200 annually, which is $1,000 divided by 5 years. However, since the equipment was paid for upfront in cash, a $200 depreciation expense is considered a non-cash expense since it doesn't involve any additional cash outflow. Consequently, when calculating cash from operations, a depreciation and amortization expense for the year needs to be added back to the net income. While depreciation is a complex topic, this simplified overview should suffice for investors. Another important line item is stock-based compensation, which occurs when the company compensates its employees with company stock in addition to or instead of cash. For instance, if you work at Facebook, you might receive $150,000 in cash and $50,000 in company stock annually. This practice aims to incentivize employees to remain with the company for an extended period and is commonly observed in the tech industry. While Coca-Cola's stock-based compensation is relatively low since it's not a technology company, analyzing this item becomes crucial when evaluating tech companies. Non-cash expenses. To provide some perspective, Facebook reported a stock-based compensation expense of $6.5 billion in 2020. Similar to depreciation, stock-based compensation expense is classified as a non-cash expense since it doesn't involve any actual cash outflow from the business. As a result, it's also added back to the net income when calculating cash from operations. Free cash flow. The net change in operating assets and liabilities, known as working capital, is a significant line item in the cash flow statement. It represents the cash needed to support a company's day-to-day operations. For growing companies, this figure is typically negative, indicating a need for more cash. However, for established companies like Coca-Cola, it can vary between being a source or use of cash depending on the year. These line items contribute to the important metric called net cash provided by operating activities or cash flow from operations. This metric reflects the money generated by a company's regular business activities and is crucial for assessing its financial performance. It's also used to calculate free cash flow, which is considered the most significant metric for evaluating a business. To calculate free cash flow from operations is adjusted by subtracting capital expenditures or CapEx. CapEx represents the cash used for acquiring and maintaining physical assets. Additionally, proceeds from the disposal of assets are added to purchases of assets to determine net CapEx, the actual amount spent on CapEx in a given year. Free cash flow is obtained by subtracting net CapEx from cash flow from operations. It represents the amount of money available for dividends, buybacks, or debt reduction. Other metrics like free cash flow yield and CapEx as a percentage of sales can provide further insights into a company's financial health and investment potential. Investing activity. Moving further down the cash flow statement to the investing activity section, there are a couple of important items to address: purchases of investments and proceeds. When a company has excess cash, it often chooses to invest in short-term, low-risk investments like government bonds. This allows the company to generate some return on its cash rather than letting it sit idle in a non-interest-bearing bank account. Next, we have acquisitions of businesses and disposals of businesses. It's common for companies to acquire new businesses as a means of expanding into new markets or product lines. This can involve purchasing 100% ownership of a company or making significant investments to hold a substantial stake. Examples: 10%, 20%, or 30%. For instance, in 2019, Coca-Cola spent $5.5 billion on acquiring businesses, which included the acquisition of Costa, a brand and an ownership interest in CHI, a Nigerian producer of value-added dairy and juice beverages and iced tea. It's crucial for investors to be aware of a company's acquisition activities when conducting research. Similarly, companies may also sell off businesses and brands that no longer align with their long-term strategies. These divestments are captured in the line item titled Proceeds from Disposals. Companies occasionally offload assets to streamline their operations and focus on their core objectives. These details provide valuable insights for investors conducting thorough research on a company's activities and strategies. It's important to monitor if a company is heavily investing in acquisitions or divesting certain businesses and brands, as it can impact the company's overall direction and growth trajectory. Financing activity. Moving to the financing activity section of the cash flow statement, let's discuss the line item labeled Purchases of Stock for Treasury. This line provides insights to investors about the amount of cash a company spends on repurchasing its own shares. As a long-term investor, I find it encouraging when a company can allocate resources towards both growing the business and repurchasing shares. To illustrate the power of share repurchases, let's consider two examples, one on a high level and another specific to Coca-Cola. In the first example, imagine a company with $100 in earnings and 100 shares outstanding, resulting in an earnings per share of $1. Now, suppose a company repurchases 10 shares, reducing the outstanding shares to 90. Watch how this affects the earnings per share. We divide the $100 of earnings by the 90 shares outstanding, leading to an earnings per share of $1.11. Through this share repurchase, the company managed to increase its earnings per share by 11% from $1 to $1.11, without actually growing its underlying earnings. This showcases the value of share repurchases for investors. Now let's explore a specific example related to Coca-Cola and its renowned investor Warren Buffett. Buffett's company Berkshire Hathaway holds the largest ownership stake in Coca-Cola, representing 9.3% of the entire company. However, when Buffett initially invested in Coca-Cola, he only purchased 6.2% of the company. Despite not acquiring any additional shares, Buffett's stake has grown by 50%. This remarkable increase is attributed to Coca-Cola share repurchases. It serves as a remarkable demonstration of the power of share repurchases for long-term investors. Share repurchases have the potential to enhance earnings per share and provide significant value to shareholders. These examples illustrate the benefits of companies effectively utilizing their resources for repurchasing shares, demonstrating their commitment to long-term shareholder value. Dividends. To accurately assess the company's share repurchases, we also need to consider the line item called Issuances of Stock. Share issuances increase the number of outstanding shares, while share repurchases decrease them. By subtracting the cash received from issuing shares from the cash spent on repurchasing shares, we find that Coca-Cola didn't actually spend any cash on buying back shares in 2020. The company received more cash from issuing shares than it spent on repurchasing them, explaining the increase in outstanding shares. Moving on, Coca-Cola is a significant dividend payer, distributing over $7 billion in dividends in 2020 alone. Increasing dividend payments are often viewed positively by investors, while stagnant or reduced dividends can raise concerns about a company's performance. To assess the overall amount spent on share repurchases and dividends, I calculate the total and divide it by the company's free cash flow for the year, resulting in a percentage. A percentage above 100 can be unsustainable over the long term, indicating potential reliance on debt or cash depletion. However, a one-year occurrence, as seen in Coca-Cola's 2018 data, is less worrisome. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.